U.S. inflation cooled in November, and of course, that is sparking hopes that it'll be enough for the Fed to keep cutting interest rates. Let's get more from Alex Grassino, Global Chief Economist at Manulife Wealth and Asset Management. Great to see you, and thanks very much for joining us.
Thanks for having me. It's a pleasure to be on.
What jumped out for you with this latest inflation report? Was there any devils in the details, for example?
Well, I think the biggest thing, obviously, was the 0.4 decline in both the headline and core data. So when you look at the year-over-year data, it went from 3.1 to 2.7. Core went from 3 to 2.6. A lot softer than most people would have expected. But to me, it's a reminder that we've moved from the delayed data to the distorted data at this point.
From the delayed data to the distorted data, what do you mean?
Yes. Because of the U.S. government shutdown, they couldn't collect all the data they would normally have had. There were clearly some fiddling, to use a technical term, with the October data to get to where they had to be. So when you look at the run rate and the very soft prints, there's a lot of numbers that just don't seem like they quite add up on this print.
That's interesting. So should we be careful even for the next couple of months of this data series?
I think that's probably a good policy. When we look at where the Fed lined up after the last meeting, it's pretty clear that they're going to pause and see what happened with the data as it came out, knowing full well that it was going to be distorted by the U.S. government shutdown. So the non-farm payrolls report was brought into stark attention and was explicitly called out during the last meeting. We do think that the CPI is just another version of this. So we'd wait till at least the numbers we get in January start to come out. And even then, we think that just one print probably won't be enough to move the Fed off its current wait-and-see approach.
So I'm taking it from that you say inflation is not completely dead.
No, we don't think so. We think that this is probably more of a distortion than an actual move down to a lower level. That having been said, when you look at the shelter inflation, that's actually started to come off a fair bit. So if that persists, that will be a more benign path for inflation than we've seen certainly in the last year or so.
What is keeping inflation higher than the Fed would like to see?
Well, there is some stickiness in areas like shelter so far.
Right.
But the other part is when you look at some of the moves higher in the goods-related inflation that relate to tariffs, that has been fully expected. And the Fed's effectively given those parts of inflation permission to stay high for a little while by talking about them as being one-off shocks. So in that context, I think if you see the areas that you would expect to run a little bit hot because of what's been happening over the last year, the Fed will look right through that, and they have a built-in reason to just continue doing what they want to do.
Do companies have, I know there's a very broad question, but do firms have pricing power right now? I know it depends on the industry, et cetera, but can you generalize?
I think that generally speaking, we're at the early stages. So far, there doesn't seem to be that much evidence of it, but it feels a little bit like it's diffused across the supply chain. One thing is that over time, especially if firms get more pricing power as the economy heats back up, which we think will happen in the second half of 2026, you will probably start to see some more pass-through, which is why when they talk about inflationary pressure from the tariffs, it's not just a 12 months and done situation, it's closer to 2 years as you start to see a bit more of that move into prices. So early stages as far as we can assess.
The Financial Times says that U.S. President Donald Trump has a problem politically with the perception anyway among consumers that the cost of living has risen rapidly. But there's only so much the federal government can do about that in the short term.
That's very true. And I think that's a classic example of Economist versus Main Street. We're much more focused on the growth rate and tying it back to the Fed's dual mandate. Whereas if you're on Main Street and you look at where eggs were from 2 or 3 years ago, the reality is that they are still a lot higher than they had been before, to use a very specific example that's come up several times in the media.
Although inflation is funny, isn't it? Perceptions, people hate it, obviously, but wages have risen, certainly in the United States since COVID. So yes. People don't apparently recognize that their incomes have gone up as well.
It's one of the reasons why we're somewhat sanguine about the U.S. economy over the next year or so. We do think that there's a potential for a little bit of a soft patch, but when you look at where the consumer is, even with flattish employment, as long as there's no acute concerns, frankly, the size of the consumer wallet has grown a little bit, even in real terms. And that means that the US consumer probably continues to spend, an important underpinning for the US economy.
What about the Fed post Jay Powell? Will we see big changes, do you think?
So the way we're thinking about it now is we're distinguishing between like-minded and independence. We think that they will remain both like-minded and independent. So that means that the likelihood that the incoming chairperson wants to see rates lower is high. However, the important question to us becomes what happens in 2027 and beyond. The US economy starts to look like it is on more stable footing, not that it's been weak so far. And there's signs the labor market slack is being removed and inflation is high. The hope is still that the Fed will continue to move higher. That having been said, if you go to May and you think very specifically about the new incoming Fed chair, we ask ourselves a really simple question, which is if they're being interviewed by President Trump and the question comes up around where inflation is, and they say, we think we're about right now, we think the odds of them becoming the next Fed chair are fairly low.
We better go. Alex, thank you very much indeed for joining us.
It's always a pleasure. Thank you for having me.
Alex Grassino, Global Chief Economist at Manulife Wealth and Asset Management.